Hi, Aaron.
Hello, good afternoon.
Good afternoon. How are you?
I'm all right. How's it going?
Very good. Thank you. I'm Harrison. I'm from IEN and just admitting Alice here now. I'll
Yeah,
be in the back end here. Hi, Alice. How are you?
Good. How are you, Harrison?
Very good. Thank you for taking the time and leading this call today. And thank you, Aaron, as well.
of course.
So I'll be in the background here pretty much if you have any technical issues. The call is recording now.
Okay.
Alice, feel free to take the lead.
Okay.
And I think we have to share some materials on screen share.
Right. I think that Aaron is the one who's going to share his materials. So does he have ability to share? I want to test that out before we open up the room.
Yes, please.
Yeah, let me see. Host disabled, participant screen sharing.
I think you have to make him the host. Do you know how to do that, Harrison?
Let me see over here. Meeting.
He's a host.
Let's see.
I think it's all that sunshine in your eyes, Harrison.
Thanks. Yeah.
You need to come to someplace where it's cold and cloudy.
Yeah.
Yeah, exactly. Okay, let me see over here, make co-host. All right. And that should do it. And let me know if you can share now.
Yeah, let me see. It looks like I can. And let's just do a practice. Share. Can you see that?
It's coming up.
Yes.
Okay.
Yes, you can make it. I don't know if you're going to use this in particular, Aaron. I know you have slides, but
Yeah.
they're very visible. The slides are.
This works?
Yeah.
Okay, good. I'll stop the share for now.
All right.
Thank you so much for doing this, Aaron. It would be really helpful. Very hard at work trying to educate the next generation of students in engagement and ESG analysis.
Yeah, we're happy to do it. I know Tim is actively involved and others in our firm with IEN. And so when somehow the emails found it to me and Jared, yeah, he was traveling and we had some issues, but in any case, we're happy we've made it work.
He recommended do both to me. So I reached out to you and then
Okay, that's right.
yeah. All this stuff happened. If there's no questions, but so the way this will work was I'll just welcome everybody, tell them what this is about, have them write their names and schools in the chat,
Okay.
And remind them of the deliverables and due dates, and that there's recordings available online.
Yeah.
And then basically turn it over to you unless there's any questions from them on any of that.
Okay. Yeah, that sounds good. And I'm going to try and be pretty high level in my initial kind of go through, and then we'll see where Q&A goes. And if they're, I don't know, if it's Friday afternoon and they're slow,
Yeah.
I can go into more detail with examples and things like that. So.
Okay, and I've written a few questions too. I know Nicole sometimes asks questions when there's none from the students. I'd rather obviously give them the floor, but if there's nothing. And I have one question for you. It looks like you're on the sort of engagement committee as well as the sort of portfolio management side. Is it fair to ask you how those integrate at
Yeah, I can also talk about our engagement efforts, how that links up to our research process. Yeah, happy to cover that as well.
Okay. It may not be part of your original presentation, but if they don't ask, I may ask.
Okay, good.
Okay.
Yeah.
So that's the whole idea of their deliverables are to come up with both a stock recommendation and a recommendation for an engagement strategy that will improve the company.
Interesting. Okay. Yeah.
Okay.
Fantastic.
How many are you expecting today?
It's hard to say. I think we've had there's 50 or so participants, and we've had 25 to 30 at the first 3 workshops.
Yep.
So, but as you said, it's Friday. The other ones were evenings. We'll see how this one. I guess there was an late afternoon on the other one, on one of them. So we'll see. Love the
Good.
dog in the back there. Like,
Yeah.
Thank you. Thank you very much. She's only a year old, if you believe it. But it looks like we have some people in the waiting room, and
Okay.
we're about on time.
Okay.
Are you both ready?
Yep.
Yeah.
Fantastic. So I'm actually going to turn my screen off and mute myself, be in the background here if you need anything, and I will let the individuals in the room now.
Okay. Great. Hello, everyone. We're going to give people a few minutes to join. So while we're waiting, if you could put your names and your school affiliations in the chat, that would be great. Hello, everyone. If you're just joining, it'd be great if you would add your names to the chat and your school affiliations. It's like we may have two McCrossons from the ASU team. I don't know if there's a brother-sister team here.
Yeah, we're siblings.
Okay, great. Good to have you both. Give it one more minute and then I'll start just reviewing your deliverables, which I'm sure you're all ready for, or already know, but just to make sure everyone's on the same page. We've got a bunch of busy students, so I'm going to start and then people may join and hopefully they'll see the chat is filled with names and schools. You may not have met me. I've met Nico, but the rest of you may not know me. I am Alice Donaselva. I'm filling in for Nicole, who has, I think she might be a bridesmaid of some sort, but she has a commitment. So I told her I would fill in for her. I am the former managing director of Intentional Endowments Network, and I'm now a senior advisor on shareholder engagement. I've worked with Warren Wilson College to help them write this year. I think they authorized 20 resolutions between 2021 and 2022 through their endowment. Their investment chair is very open-minded and created a separate account. So that allowed them to authorize resolutions through As You Sow, who you may have heard from earlier if you joined the earlier workshops. So in addition, I helped them do some proxy voting and just to educate them about shareholder engagement and how it works. So my job today is just to remind you to introduce this workshop. So the first three workshops were specifically about shareholder engagement. The first one was more about the theory and history. And if you joined, I think there was a good argument at the end about the impact of shareholder engagement. The next one got a little bit deeper into how you use research for that. And the last one more to the legal nitty gritty. All of those should be available online on the Silk website, I believe, but also Nicole sent you an email about a week ago with the links. So those have all been recorded. If you missed it, they're available. She also sent recordings to the Federated Hermes workshops. So Federated Hermes just put some, not so much workshops, but educational pieces online, their videos, video trainings. If you hit the Academy one, when I did that, didn't work. They're working on their website, but the other one does work. I think it's called the Responsible Investing Institute. I see a few more people joining. So if you're just joining, it'd be lovely if you'd add your name and school to the chat. So my last piece is or last two pieces are to tell you about deliverables, just remind you, and then to introduce our guest speaker, Aaron. I should have asked you the Ziulkowski. I'm not anywhere close. Is that right? Okay. So your deliverables is probably already in your head. You have written deliverables, both your company analysis and your shareholder engagement strategy due on April 8th, which if I have it right is about 3 weeks away, I think. And that goes along with a recorded presentation. Those will be evaluated by judges by April 22nd. So about 2 weeks after you put them in. And then finals will be April 25th. I will open it up for a minute for any questions on, I can't tell you much about the deliverables themselves, but I can answer questions about dates perhaps. Does anyone have any questions? Okay, you guys are good. Okay, so Aaron is from Boston Trust Walden, who is, they're a member of IEN, and we've done a lot of work with Tim Smith, who you've already heard. Again, if you listen to the first workshops, he is a guru on engagements, been doing it for decades, and went through the history, and I think played a sort of facilitating role when there was an argument between Heidi and Andy. So anyway, so you've seen him, and he is still with Boston Trust Walden, but more focused on shareholder engagement. So Aaron is actually doing the portfolio management and stock analysis. And so you're going to hear more about how all that works today. I'm going to turn it over to Aaron.
Thank you, Alice. Good afternoon, everyone. Happy Friday. Good to meet you all virtually. My plan for this afternoon was to go through a few slides that I believe has been shared with you, kind of high level, and then open it up for questions, at which point we can go into as much detail on kind of whatever issues are of interest. In addition to the slides that we sent through, I believe you also got two, like a 3-page and a 4 or 5-page handout that kind of in more of a narrative form describes our ESG research at Boston Trust Walden. So hopefully you had a chance to look at those and they kind of had come with a few questions. Before I dive into the details, just a little bit about myself. I joined Boston Trust Walden 9 years ago. When I joined the firm, I actually joined as a member of our ESG research and engagement team. So I worked right alongside Tim Smith on engagement activities. I was responsible for helping move forward our engagement strategies on climate and environmental issues. And at that time, and we continue but at that time, we started our focus on asking companies to set science-based emissions reduction targets. So that was a big part of my job. And then the other part of the job when I joined the firm was doing ESG research, which is kind of what we're going to talk about today. 4 years ago, I transitioned into a role as a traditional fundamental analyst. And so in that role, I guess I do what people probably stereotypically think of as investors doing, reading financial statements and disclosures and doing more traditional financial and fundamental analysis. Unique for a long time anyway at our shop though is that we always included analysis of environmental, social, and governance risks and opportunities into our fundamental analysis process. That's of course no longer unique. Numerous investors do that. Hundreds, in fact, are doing that. And I'm sure you're familiar with the Principles for Responsible Investment, PRI, which is a coalition of global investors with something like 100 trillion in assets under management, all of whom are doing this type of analysis. So I spend most of my time on the fundamental analysis side of things. As a firm, most of us are generalists, and so that's kind of important because it informs the way that we think about stocks and we do our analysis. I do cover a few sectors, and they happen to be sectors that are more environmentally intensive. So they include utilities, energy, industrials. But in any given week, I may be looking at companies from any sector across the economy. So that's the, well, actually just one more way of, by way of an introduction, one more point. Prior to joining Boston Trust Walden, I worked at Ceres, which you may be familiar with. It's an environmental advocacy organization that works with business investors to advance sustainability issues. And preceding that, I actually kind of had a career change, but I worked in international development. I was based in Washington, D.C., and did a lot of work in sub-Saharan and Central Africa. But as part of that work, we did some engagement with multinational corporations, many of them extractive companies, that were working in the countries where my NGO, our NGO, had projects. And so I kind of gained some perspective of on-the-ground impacts of company activity, as well as how companies think about managing risks and opportunities associated with operating in complex environments. So all of that kind of plays together nicely as we think about how to do fundamental analysis and make investment decisions that incorporate this set of issues. So I'm going to share my screen now, and I'll put up the slides that again, I hope you've received them. But this will guide our conversation here for the next few minutes. Okay, I assume you can see this. Someone, Alice, can you confirm you can see the slides? Yeah, okay, good, great. All right, so before diving in, this slide kind of frames how we at Boston Trust Walden think about achieving impact. And you can see this pie in the bottom left of the chart in various different slices. But the first slice of the pie is ESG research and integration, which is what we're here to talk about today. But we think that's an important tool in achieving impact. It helps us build portfolios that help our clients achieve their missions and values-based objectives. The company engagement follows on immediately and nicely from our research and integration efforts. And I'll say a little bit about this, but our research process informs our engagement. So as our ESG analysts and fundamental analysts are assessing whether or not a company is appropriate for clients, and they're identifying potential areas for engagement should we own the company. So that kind of feeds nicely into the process. Shareholder resolutions are an important tool that we use as a firm. They're an important tool, especially when engagement through other means breaks down. They're a good way to get companies' attention, and I gather that you've heard all about that as a tool. Proxy voting, of course, is an opportunity for us to formally indicate to the company how we view various issues, whether it's the compensation packages, the structure and the actual size of the compensation package for the CEO, or shareholder sponsored resolutions that cover a whole variety of issues. Public policy advocacy is a tremendously important part of what we do as well, though, for a couple of reasons. But one, the extent to which we want to see change, systemic change, we recognize that engaging company by company might not meet our goals, and what we need is public policy that influences and impacts all the actors that are involved in any given issue. So that's an important part of what we do. And then thought leadership is equally important, as we believe that sometimes kind of the only thing that's standing in the way of change is imagination and just demonstration of what's possible and how things could be different. So now getting into the research process, when I think about ESG research, and I recognize that there's sometimes some confusion around what different individuals mean when they use different terms. So I'll try and explain explicitly what I mean by these terms. But when we talk about ESG research, we're actually referring to our efforts to answer two questions. The first is whether or not a company meets our values-based or mission-aligned criteria, and that's what you see outlined on this slide, and I'll go into more details. The second question that we're trying to answer as we think about ESG research is, are any of these ESG risks or opportunities financially significant or material to our investment case? And so if you think of kind of a spectrum with kind of values based on one side and value or financial significance on the other side, the spectrum is important because these issues aren't always just one or the other, but they can be a blend. And the materiality of an issue is dynamic and it can change over time. So an issue that might be a values-based issue today could very well have a material impact on a company tomorrow, so to speak, as consumer preferences change, as societal expectations change, as regulations and laws change. So I actually think these two pieces of research fit together nicely, and they inform each other. As it relates to making investment decisions and trying to kind of isolate them on financial materiality, it can be a challenge because we in some ways have to put aside what might be our own view of how the world should be in order to ask tough questions about how likely is this issue to impact positively or negatively the overall investment case that we're trying to make for a company. So now on the ESG research assessment here, you can see we've got 3 panels. Part of this is what I would call just kind of industry standard product and service screens. That's what you see in the left here, these 9 categories of issues. If companies derive a significant, usually defined as 5 to 10% portion of revenue from these categories of operations, they would be considered ineligible for our impact clients. And this is a values-based screen. We're not making a specific determination about the financial materiality yet at this step. So kind of to state it another way, there are plenty of defense contractors with which we would not invest because of this set of screens. But those same defense contractors may indeed be excellent investment opportunities. So at this stage, all we're saying is we just don't think they're appropriate for values-based reasons. In the middle of the chart here, you see the kind of the comprehensive way that we do this research. So for every company that we look at, and in any given year, at our firm, we own about 270 companies. So we're active managers. We're actively selecting where we invest. We're not just investing in every company in the different indexes to which we benchmark ourselves. Every company that we look at, we're doing this comprehensive ESG analysis, looking at everything from corporate governance to community impacts and human rights issues.
Contract, right?
I think someone needs to mute their line.
I'll refresh it on Monday.
Moving on to kind of what this means. Thank you. Once we've done our data gathering, we then have to make an assessment of the company's performance. And you can see here, there's a couple of several parameters that we use to guide our research. And one of them is, how does the company's performance and track record look compared to its peers and compared to its own history? If there's a problem that emerges, we could try and get a sense of the extent to which that problem is systemic, whether it's repeating, what's driving it, and make a determination about the response from the company. Just because we identify a challenge or a problem with a company doesn't mean that we would exclude it from investment. We recognize that no company is quote unquote perfect. Many companies have had challenges of varying degrees and over time. So the response of management is quite important. Factored into that is the extent to which we believe that the company may be open and willing to engage with stakeholders and shareholders. If there's a reasonable likelihood that we think that we can make a positive impact through our share ownership and engagement, that may tip the scales in favor of owning a company. So now moving on to ESG integration. So this is our process that we use to answer that second question. It's kind of what's the financial materiality of these ESG factors. So as a base, we've done this comprehensive research, and what we do here is based on the specific industry of a company and its specific operating model. We identify issues that may be financially material. There's a variety of inputs that we use here in identification. Our own history is a big part of it, and I didn't say at the outset, but we were founded in, I think, 1975, and since that time, we've been thinking about these issues as part of our investment process. So we have nearly 50 years of experience weighing the risks and opportunities associated with ESG issues. But we also look to third-party frameworks like the Sustainable Accounting Standards Board, SASB, their framework for materiality. It provides a good guide for what is likely to be financially material. But we also recognize that any framework like that is by nature has to make some generalizations. And so it's important to look at the specific operating model of the companies the company in question, and to determine the extent to which the issues identified may be areas of significant risk or opportunity. I didn't go into the detail about the source of our information on the previous slide, but the sources are the same. So here we utilize third-party research groups like Sustainalytics and MSCI, the reports that they develop. I don't know if you all have seen those, but both of those firms have for decades been producing ESG and sustainability related research, and they're a good resource. Increasingly, companies disclose through various mechanisms ESG related data. As you get to go up market cap to larger cap companies, you get increased disclosure generally on these issues, and it comes in the form of standalone reports. But we also look to various other sources. Important in our process include government databases such as OSHA databases to identify patterns of negligence or fines related to workplace violations. EPA databases can give us insight into how companies operate from an environmental perspective, where we can get information on waste, water pollution, carbon emissions, and other environmental emissions. Beyond the government databases, we look to research from advocacy organizations. I mentioned Ceres earlier, so they're frequently producing research that informs our process, but we also look to other environmental advocacy and social advocacy organizations, whether it's Human Rights Watch or Natural Resource Defense Council, Environmental Defense Fund. All of these groups provide useful research, both generally on issues, and many of them also provide company-specific research that we can utilize. And then finally, academic institutions are important as well. less so on company specific research, but they can be excellent in helping us understand issues. There was a number of academic institutions that have done a lot of work on the impacts of the oil and gas industry, for instance, and so we can avail ourselves of that information as we're trying to understand the complex issues. Which is, again, as I said, we're generalists as analysts and background. If anything, we're specialists and fundamental analysts, but we're not experts in any of these E, S, or G issues. And so these resources are important to our process. Once we've gathered all that information, it's time to, this is kind of where the rubber meets the road. We have to evaluate it and incorporate it into our investment decision process. As it relates to ESG integration and financial significance, it's important to, it's helpful to contrast this piece of the project with the previous, with the values-based screening. ESG integration is not a screening process for us. It's not a in or out or a binary process. We don't come up with a view of the financial materiality and then, in absence of any other information, make a decision about the appropriateness of an investment. What we do is we take that information and then we think about its impacts on kind of the traditional drivers of fundamental value. What's the impact of this issue, or probable impact of this issue, on the company's ability to generate future revenue? How may it drive expenses? What impact may it have on the balance sheet, whether in the form of assets or liabilities? And then we also think about many of the issues end up falling in a third bucket, which is just overall risk. You could think about, if you're thinking about fundamental analysis, often you're doing some sort of a discounted cash flow analysis of future cash flows, and you have to discount those cash flows at some sort of rate. So here the idea is that the riskier the company, the higher the discount rate would be. We don't tend to get too precise in our approach to that. We're not trying to adjust a discount rate by 50 basis points or 0.5% because a company appears to be above or below average risk from an ESG perspective. But rather what we're asking our analysts to do is to say, given what you know about the ESG profile, does it increase the risk profile overall of this company or decrease it? And if so, what's that mean for valuation once we get to that stage of our process? I think this is my last slide. On this slide, we show a tool or a framework that kind of helps us distill all of this information. We call it the spectrum of financial outcomes. And this has been helpful for us for a couple of reasons. First and foremost, on the left-hand side, as you can see, it forces our analysts to recognize that ESG issues present both risks and opportunities. It'd be easy in some cases to avoid or forget or miss the fact that both risks and opportunities are present. Second thing that it does is these 5 categories, we feel, generally cover the waterfront of ESG issues that a company faces. The categories aren't necessarily mutually exclusive, but together we think that they're collectively exhaustive. And so they help us make sure that we're thinking about the nearly infinite ways ESG issues can manifest themselves in a company's operations and can impact its future sustainability. The analysts will prepare a report in our process. The analyst will prepare a report that includes a specific page with a matrix, essentially, that includes these categories, and risks and opportunities associated with each of these categories are identified. In the summary of our analyst reports, we ask our analysts to make a one-line summary of the ESG materiality. And that's intended to just give a quick sense or a quick check of how ESG issues impact the overall quality or sustainability of an investment opportunity. And then this provides for further detail. So let me just provide one opportunity or one example of how we use this framework. It was actually, I don't think we included this particular example in the handouts. There are a number of examples in the handouts, but in our smaller cap strategies, we intend to maintain some sort of sector comparability, which basically means that among the 11 GICS sectors, we want to be within plus or minus a couple percent of each of those sectors in our exposure. And so that means that, with the exception of for fossil fuel free clients, we are investing in energy and utilities, companies that have big environmental impacts, as well as potentially significant environmental risks. And so the example I'd provide is some analysis we did of two smaller cap utilities about, well, it was a couple of years ago when we did the initial analysis. Both of these utilities were based in the Northwest of the United States. One's called IDACorp. It's based, most of its operations are in the state of Idaho. It has some operations in Eastern Oregon as well. The second utility was called NWE, and most of its operations were in Montana. Both companies had exposure to coal-fired generating capacity. That's a concern for us. And as we did our analysis, we identified that as probably the most significant or potentially significant ESG risk or opportunity for the company, for both sets of companies. When we dug deeper, we found that the two companies were addressing the issue in significantly different ways. In the case of IDACorp, they'd actually set a goal to be carbon neutral by roughly mid-century. And in order to achieve that, they were actually already on their way to retiring their coal-fired power plants. These coal-fired generating facilities were jointly owned with other companies, but they were in the process of retiring those and had a very specific timeline for doing so. They had engaged with their regulators and had approval to do that, and seemed to be navigating the issue appropriately. In contrast, just to make a long story short, NWE did not have similar corporate-wide targets, and it wasn't making any efforts at that time to retire its coal-fired generation. So ultimately, we approved IDACorp for investment for our clients, not only based on the fact that it was handling the environmental issue in a reasonable way from our perspective, but based on its overall investment characteristics. It was in a state with a reasonably good regulatory environment. Demographics in the state were favorable from our perspective, which is to say that the state actually had a growing population, which provided the chance for growing revenue for the utility. Profitability was stable due to a variety of regulatory mechanisms. The profitability level itself was comparable to what we would expect a utility of a similar risk profile to generate. Its balance sheet was comparable to that of any other utility, and valuation was determined to be reasonable. It was somewhat elevated, but we thought, given the overall favorable quality profile, it was probably a fair valuation. So that's one specific example of how we identified an issue and then how we integrated it into our assessed the issue and integrated it into our analysis. Kind of in conclusion, I guess what I would say is an investment firm's ESG approach to ESG integration has to be tailored to its investment philosophy and its investment approach overall. And I'd hasten to say that there are numerous different approaches to investment, and I wouldn't make a particular judgment about one versus another. There are numerous good approaches to investing. Our approach to engagement, our approach to investment and ESG integration match up. We're long-term owners, so it makes sense for us to look long-term at ESG risks and opportunities. The long-term nature of our investments also open doors for engagement. Engagement's a process that plays out over years. It's rarely a quick process, and so that fits nicely. The fact that we're looking for stable companies also, I think fits nicely with our emphasis on ESG risks and opportunities, because oftentimes these ESG risks and opportunities can create let's call it just bumpiness in sales. They can impact profitability in the near term as well as the long term. So the approach, and again, I don't know a lot about the different projects that you all are working on and the companies that you're looking at and the way that you're thinking about this, but I would hasten to say that our way works really well for our investment approach. But there are many ways to think about how to integrate ESG factors into an investment process. Thank you.
Thank you so much, Aaron. I have a couple of notable quotables while you are going on. I love your quote about the only thing standing in the way of change is imagination sometimes for companies. So got that one written down as a memorable quote. So I want to open this up to questions, but many of you don't have your video on. So I think what we'll do is you can raise hands using the reaction button if you're more comfortable keeping video off. But if you're keeping it on, feel free to just kind of wave if you have a question. I think I'll see you. There's only about 15 of you on the screen. So have at it if you have questions. I see one from, I think it's Madonna Morris.
Yes, hi. Hi, can you
Hi.
hear me?
Yes,
Hi.
we can.
So this might sound like a basic question, but we're currently working on a financial model. I have a pure finance background, so I'm just like doing a basic model right now, and I'm looking to how am I gonna adjust the valuation based on the ESG factor? Aaron, you mentioned that we're gonna reflect it a little bit in the discount factor. Are there any other ways where I should be thinking about or consider accounting for it in my model as I do my forecast?
Yeah, it's a great question. Again, I don't know how detailed your model is, but various ways that we've thought about it would be, as you're thinking about the cash flows and the future cash flows, the magnitude of those. So a number of the companies that we invest in, especially on the smaller cap side, can derive significant new market opportunities from ESG related issues. And so you may want to, depending on if it's an opportunity, you may want to increase the revenue expectation. Of course, you know, if you're thinking about cash flow itself, you're going to want to think about the profitability of the revenue opportunity. Just because there's more revenue doesn't mean that, you know, it'll have the same margin profile as existing streams of cash flow. And so that's one way to think about it. Another way, again, thinking about ultimately ending up at some sort of cash flow is expenses. And so in some cases, companies that are facing increased regulation that may drive operational expense, additional operational expense, which would decrease cash flow over time. So those are two additional kind of areas where you may want to consider. I guess the final point I would offer is, and this is again very much steeped in our approach to investing, is we want to be humble about our ability to forecast the future. And so generally we think that thinking in terms of scenarios is probably a better approach, because we don't actually know which, you know, the future is so complex in the near term as well as the long term. So thinking in terms of some scenarios can be helpful, and identifying kind of, well, you know, if everything goes well, this is our scenario. I guess basically you'd say you have your base case scenario, you have your optimistic and your pessimistic scenario.
Perfect. Thank you so much, Aaron.
Yeah. It occurs to me on that question as well. You may have seen, but a couple of years ago, the PRI published a compendium of case studies on ESG integration, and asset managers from around the world submitted case studies. And if you take a peek in there, you'll see how some different managers do just what you're talking about. So that might be a helpful resource.
Great. Thank you so much.
Yeah.
Any other questions? Again, feel free to raise your hand if your screen is showing, or just stick up one of those yellow hands if not. So Lindsay?
Yeah, hi. Thanks,
Hi,
Aaron.
Lindsay.
It's nice to meet you. Appreciate your time today. I was just curious because I know you had noted a couple of areas that you focus on when you're doing your sort of ESG data collection. And I was curious particularly about you mentioned like DEI and human rights. And I was curious if you could share, what kind of data you specifically pull, or are you looking more for policies, or how do you balance sort of that like policy versus performance review of
Yeah.
people's perspectives? Yeah,
that's a great question. We are looking for policies to be in place at companies. So our ESG team will note on any given issue, whether it's an environmental issue or a social diversity, equity, and inclusion type issue, we'll note what policies are in place at a company. On DEI, we're looking at policies as they relate to board level diversity. So what sort of things are written into the charter of the nominating committee, and in particular if they're looking for diverse candidates, and then kind of at the executive and then management level, similarly looking for statements or policies around hiring practices and goals as well. When we talk about policies, we also kind of incorporate into that goals and targets, because that all kind of forms a kind of a package of governance, good governance, if you will. That reminds me, at the board level, we're also looking for companies that include a commitment to have a diverse slate of candidates when they are looking to fill a new or existing board position, referred to as the Rooney Rule. So that's on the policy side. Then on the practice side, obviously policy is good, but we want to see practice change. And in order to see that, we need transparency. We ask companies to disclose their EEO1 data, which is data that US-based companies, over 100 employees, gather and disclose to the government, but aren't required to disclose publicly. And so we're asking companies to disclose that publicly to investors, and an increasing number of them do, especially among the larger cap companies. And so that gives you breakdown by job category, by race and ethnicity, as well as gender, I think, and enables some interesting types of comparison. In addition, on DEI, what we'd be looking for is any evidence of problems. So, class action lawsuits or different labor suits that might allege discrimination or discriminatory practices in hiring or promotion. Those types of issues often, especially with big companies, are high profile. And it will make the news. What's challenging there is to then figure out, was this like a one-off thing, or is this a systemic issue? And there, I think, is kind of where you see the advantage of trying to pull all sorts of different data, is it together creates a picture. One piece by itself can be misleading. In investment theory, they talk about the mosaic. Investment research, they talk about mosaic theory, and it's this idea that you're gathering numerous pieces of data, and together it creates a picture, a mosaic. And that mosaic or the combination of all of that data might lead you to some unique insight that just having one or two of the individual pieces wouldn't have yielded. Did I miss anything in your question?
I don't think so. I think that was great. Thank you so much.
Okay, Cameron, you have a question?
Yeah, I do. So it's a great presentation. I had a question regarding corporations and basically their corporate structure, not only just in the governance, but as a business as a whole. So I've always been, one research that I've been doing is in terms of ESG is basically incentives and understanding the construct of B Corps, where like I really want to find companies as like why companies today are not considering changing their structures into a B Corp to basically legally enshrine the interests of broader stakeholders, not just the shareholders.
Yeah, that's a good question. I'm not a legal expert on corporate structures, and I don't know. Yeah, I don't know the complexity of if you're an existing corporation and a listed corporation with publicly traded shares, kind of making some of those sort of changes. And I have to admit, I can't think of examples of companies that have off the top of my head that have made kind of that change while they're a publicly traded company. I know that a couple of years ago, there was quite a bit of, what's the right word? Eyebrows were raised as a number of large publicly traded companies kind of explicitly said, in order to be well-managed companies, we have to take into account a broader set of stakeholders, and we can't just be focused on shareholders, and that was just considered rather polemical, controversial, and I think it just kind of harkens back to a long debate about the purpose of a corporation and Milton Friedman and kind of different ideologies around capitalism and the primacy of the shareholder versus the stakeholder. But my sense is that, so kind of putting aside the question of actually a formal change in corporate structure, my sense is that increasingly companies explicitly recognize the importance of managing their operations in a way that takes into account concerns of a whole host of stakeholders, and they've kind of done away with this idea that you can just kind of narrowly focus only on creating profit or maximizing profit for shareholders in the short term. But that's that's still very different than kind of legally binding oneself to this broader set of stakeholders. So I'll be curious what your research yields. I don't think there's been a lot of progress here in the U.S. It could be that in Europe there's other more maybe the conversation's a little bit more advanced. One additional thing I wanted to mention though is when we look at incentive structures within companies, one of the key things that we look at are the way that the compensation is incentivized for the CEO and other named executive officers, NEOs. You get this data through the proxy statement, and companies disclose it every year, and increasingly it's more and more detailed. But numerous companies, an increasing number of companies, are building into their CEO's executive compensation, both their short-term bonuses as well as longer-term various ESG considerations. So in the sectors that I cover, that most frequently includes like safety metrics, and so companies will be striving to drive down the injury rate among their employees, and if they do, then the CEO will receive some sort of a bonus, or if they don't, they won't. So that starts to kind of link incentives in a formal way, but again, it's just kind of a very small piece of this bigger picture thing that you're talking about.
Yeah. Yeah, thank you. I think my second question is regarding, so I currently do researching, and I do corporate engagements with some of the companies that I cover. And one question that always gets bring up is building an ESG framework that is future-proofed for tomorrow's economic realities. So like, for example, like for retail, which has seen strong growth in diversity data within their staff today, but the reality is that a large proportion of that population is of less skilled workers and who are vulnerable to losing their jobs to automation and digitization. So I'm just really curious as like tips or in terms of any kind of resources in working with these companies on developing a structure that can make with a framework that is extremely robust to whatever economic changes happen, per se, in the next 5 years.
Yeah, the creative destruction of the capitalist system is impressive, and it's awful, and it's amazing, and it's a whole lot of things. When you have a society where there are inequities, it means that different groups of populations will be impacted in different ways, inequitably, by those the creative destruction of the capitalist system. So what you're talking about is extremely complex. But two things come to mind. One is, I mentioned EEO-1 data. We think that that's important in the disclosure of that, because then you start to get quantitative data to help you understand the status as of today of the workforce. Who women and minorities, are they all kind of in the lower level positions? And then you can start to measure over time if that's changing at all. And it will take time to promote and hire. To promote, in some cases hire, but also to then promote and get minorities and underrepresented groups into different roles in companies, in technology or various industries struggle with this. But anyway, the EEO-1 disclosure, I think, is an important piece. And then the second thing is better understanding really what a company's, what sort of resources they're providing to train and to help this upward mobility, and what sort of like resource groups are available. This is a little softer. It's not so like quantitatively driven as the EEO-1 data disclosure, but it's an important piece of the puzzle, because it helps you understand what are the chances that a minority is going to actually be able to move up, what resources are available within the company to help him or her advance.
Yeah. So my final question, this is not with the companies, with me finding new opportunities for companies, is how could I change my ESG research process to basically take out the risk that I'm going to invest in a company that is greenwashing? So I'm really like, my fear is that I invest in a company that is basically, they say they are green, but they actually are not green. And it's just like, what steps could I take, or what kind of key points that indicate that company may be greenwashing?
Yeah, it's a great question. I think, and it's relevant to investment analysis generally, but what's most important is that you have a framework that you use to evaluate companies that's based on issues that you think are important, and you assess the company against that framework or rubric. And in so doing, what you'll help yourself do is you'll help avoid that greenwashing, or just in general, you'll help avoid, how do I say this? the management of companies, the CEOs of companies, the IR of companies, they're excellent salespeople. That's part of the reason that a CEO is a CEO, is because he or she is extremely convincing, able to communicate in a way that makes people want to believe what he or she is saying, right? That's how you get to, one of the ways you get to be a CEO. And so as a result, and again, this is generally applicable to investment analysis. They're very good at presenting their companies in the best light, and that, again, in our framework, that's why we have the risks and the opportunities, and we push our analysts to think about these issues using that structured framework. Here's the criteria we're going to measure you against, and do think about the strengths and the weaknesses, the risks and the opportunities. And then once you've done that, then you just figure out on your own, like, well, how do they stack up? And so it becomes a little bit less dependent. The last thing I'd note is, and this isn't helpful immediately, but over time, the SEC is going to get involved, or is involved, and is going to start to scrutinize disclosures around ESG issues in a more robust way. And that'll help institutional investors, it'll help retail investors, it'll help all sorts of stakeholders to cut through greenwash, or the kind of the fog and the haze that's created around this really effective marketing efforts from some companies.
So how could the SEC take in a part in basically the regulation of companies that greenwash?
Yeah, so the SEC scrutinizes anything basically that the companies disclose to the capital markets, and so they can require the Form 10K that all companies use for their annual reports. It's a framework and a rubric, and the SEC has determined these are the things that companies need to disclose, and then so the first thing they could do is add things that have to be disclosed in there. An example would be a decade plus ago, it required that all companies make a disclosure around the sourcing of so-called conflict minerals in their supply chain. So tin, tantalum, tungsten coming out of Central Africa, basically. And what steps have you taken to make sure that you're not perpetuating conflict in sub-Saharan Africa through your sourcing? So that's a tangible example, and they could just apply that more. They could apply that more broadly, and they're actively considering this right now. Kind of what sort of framework should be required, what should be mandatory ESG disclosures, and then once you have that framework, the SEC can get in there, scrutinize the actual disclosures, and say, yeah, this is factual or this is misleading. And if it's misleading, then they can penalize companies.
Okay, thank you.
Yep.
Got a question through chat. Also, Aaron, do you have time for another question? It's 3:58.
Yeah, no, I'm happy to stay on for a little bit more.
Okay. This question asks, how deep into supply chains do you research? And this could be broadly, I guess, too. Do analyst research, and how do you consider different regulations as part of risks and opportunities?
Yeah, so it's industry specific, but for certain industries, we think that understanding and scrutinizing the supply chain is incredibly important. I just mentioned the conflict minerals issue, so that became an important issue for a lot of technology companies that were using those minerals. It's also important for numerous industrial companies, and actually it was farther reaching, I think, than probably the activists when they were first trying to push this issue probably even realized. Similarly, apparel is an issue that's had just a huge amount of scrutiny over decades now, into the challenges of the supply chain, whether it's child labor or forced labor. There's a whole host of issues, and then also various food product companies. There've been exposés and excellent research done that shows, again, forced labor and child labor in chocolate supply chain and things like that. So it's a part of our research framework. I have to admit, for utilities, we don't generally look at it, but just last week we were on a call and we were talking about some issues with the Muslim Uyghur population and the solar value chain, and this utility company also has installed a significant amount of solar, and so we were probing to better understand what sort of due diligence the company had in place to manage those issues. So supply chain does play an issue, but it's industry specific. And then the second question about regulations as part of risks and opportunities, it's certainly an important part. I would kind of, as an investment analyst, I would say that with regulations, the one thing about them is that they just create a level playing field. So everyone kind of has to follow the same regulation. Different companies will be impacted in distinct ways, though. But generally, it's actually not too difficult of analysis. You can kind of say, well, here's the bar, and it's going to cost this company $10 million or whatever to install these new pollution scrubbers, and here's how this is going to play out. What I think is a little bit more challenging is that the area of like, well, is there going to be future regulation around a certain issue, and how are companies positioning themselves to mitigate the risks or take advantage of the opportunities associated. And that's, again, that's kind of speculative, and it's looking into the future, and it's uncertain, and we don't really know. But that's a big part of what an investment analyst does.
I have a follow-up question from someone else on supply chains. I'm curious too, what research you use. Do you research the supply chain on your end, or do you rely on companies to have robust reporting practices around that? I know I don't know if it's something replaced Know the Chain. God, I don't know if they're still around, but I know that used to be one source of data.
Yeah, I knew them, and actually I can't tell you if they're still out there or not. But so we would look at the disclosures that companies provide, and again, depending on the company, and often if it's gotten in big trouble in the past, its current disclosures are pretty good because they've had a lot of scrutiny. So you think about a company like Nike, you get a lot of data from them about supply chain. So we look at the companies, but then this is where the third-party analysis of various NGOs, often human rights groups, comes into play and is quite useful, and helps us create a picture of what's going on. And then usually what we try and do is, through our engagement efforts, take what we've learned from the third party and talk to the company about that, because we've also recognized that these issues are sometimes even challenging to accurately characterize, period, right? And so we can't necessarily take at face value anything that anyone writes, not because I would say that someone's trying to be deliberately misleading, but simply because these are complex issues and there's different sides to stories. And so through our engagement efforts with companies, we can learn more and understand how they perceive what's been written about them. But ultimately, we're looking for data from as many sources as we possibly can. Bloomberg itself has some, like the Bloomberg terminal that investors use, has some supply chain mapping tools that help you understand, as does FactSet, that help you understand country exposures. So that can be a piece of the puzzle. So there's a variety of resources out there.
Great. Any other questions? I'm seeing several thank yous on the chat, Aaron, and a heartfelt thank you from IEN. This was a great presentation, and I hope helpful to everyone. And thank you all for joining on your Friday afternoon. I know it's a rough time, so we appreciate it.
Yeah, thank you all.
Let your colleagues know there will be a recording. I think it'll be next week by the time it's up, sometime later next week. Thank you all so much. Oh, I see a hand. Lindsay? No, it was just a clapping. Okay. I have to
Thank
get
you,
used to
Alice.
the
Thank you,
little
Aaron.
symbols.
Thank you, everyone.
Thanks, everybody.
Yep, thank you.
Thanks.
Have a nice weekend. Bye-bye.
Thanks again, Aaron. It was great.